Welcome everybody to the SME South Africa Podcast. I'm your host, Marina Stein, also the editor for SME South Africa. And today we're talking about funding readiness and accessing funding. When we say funding readiness, we talk about a business ability to access funding and know how to use it. But the problem that often occurs is that businesses aren't prepared. This means that businesses have poor financial records, unclear use of funds, compliance issues, and a lack of demonstrating growth. But joining me today is Jenna Sprenger, who really understands helping businesses conquer these issues. She's a chartered accountant and founder of Kayzi Growth Readiness, a South African platform that prepares SMEs for funding before they apply. She's spent 12 years in the corporate world as a Group CFO at the JSE-listed group company, raising debt from every major South African bank. Today, she also runs a masterclass program on the true cost of capital and writes the weekly newsletter, Eish, Am I Ready? Jenna, thank you so much for joining us today.
Thank you. Very exciting to be here and looking very forward to the summit in the next few weeks.
We're so glad to have you on board for this episode and to hear what you have to say at the summit. Jenna, you work closely with businesses and being funding ready. What is the biggest pain point you've identified?
So I think there are two different types of businesses that approach me. One, quite early stage, what you find is it's almost like, if you compare it to someone walking into an interview, they walked into an interview without realizing it was an interview. They had no CV, they hadn't done any research on the company, and they're completely unprepared and they're trying to wing it. I find a lot of businesses do that with debt. They're great businesses, they've had a great idea that's maybe taken off, got a bit of traction, and now they want debt quite desperately because, they want to take it to the next level. But they haven't prepared properly. They don't understand what the banks are looking for and what they need, and they're kind of walking in blind and hoping for the best. What inevitably happens is the bank then rejects them. They walk away completely deflated and say, the bank turned me away, now what? I'm lost, and sort of give up and don't want to take out debt again. I mean, that's almost the worst case scenario because it's actually a good business that just wasn't prepared. The other type of businesses that I find, and probably more of these that come across my desk, are the more established businesses that have taken out debt in the past but are in a little bit of a pickle now, have got a little bit burnt, either like some sort of structure that they're trying to get out of, or they've put debt on debt on debt, and it's all expensive debt, and they now need to work out how to get out of it. So they need a broad restructure, someone to just look at their business with fresh eyes and see what they can do. Or they actually went and got debt quickly because it was easy and accessible, and it was the completely wrong type of debt for what their business needed. They didn't understand that there were various different types of debt products, and they didn't do a matching exercise with what their business offers and the type of debt that would rightly support their business into the right growth areas. So that's what I see as the biggest gaps to fill.
And how do you then help those businesses?
So it's more of an advisory type service that we provide. One, it's spending a little bit of time understanding the business, understanding the type of business that they do, and then matching them to the right lenders. So, for example, if it's a property developer, they would need some sort of asset type lender or asset-backed lender that would support them. If it's a business that does invoice, has lots of suppliers and needs working capital because they have a purchase order kind of mechanism, then it's purchase order funding. So it's about understanding what the business needs and matching them to the right lender to support their business. Their working capital facilities, their purchase order funding, There's invoice discounting offerings. There are so many different types of lenders out there. And even within the same lenders, they often different products. But if the business doesn't know what product to ask for, they often get it wrong.
This matching function you assist with. So generally, we refer to the companies who does this as funding intermediaries. I like to sum it up as the person who might not have the wallet to disperse funding, but can connect you to the person with the wallet. What role do you see intermediaries play when it comes to closing the funding gap?
So I think that is right. I think they do play that role and they match. But I think you do have to be careful in saying that, because I think that's probably the negative spin on what an intermediary does. I think an intermediary can play a massive role in the fact that what is amazing about the world that we find ourselves in today is there is actually so much capital available, and we can come on to it a little bit later, but the fintech banks that have now launched, I mean, they've made capital incredibly accessible, and you can almost knock on any door and get cash in your bank account in 48 hours. The challenge and the counter of that is that you have got businesses that have now gone and done that to get cash quickly, but they've been matched to the wrong product. So, for example, you'll have a business that's gone and taken out a working capital facility, which is supposed to be a facility that you draw, and then when your cash comes into your bank, for whatever reason, you get paid for the product, your stock comes in and whatever, and you draw on the working capital facility to pay for the stock, and when your customers pay for the product, you settle it. And it should be a facility that's drawn and settled. Businesses go and take out working capital facilities and then draw it and never settle it because they're using it for something else. So they go and fund machinery, or they go and fund a big capex project, and that is very expensive debt being used in the wrong way. If you need a capex facility or something to go and fund, you should go and get asset-backed funding. That is a much cheaper form of funding that will help you in the long term and support the business. So, I think that's kind of the role of the intermediary. So to identify what the business actually needs, match into the right funder, and to understand the business better than a lender. Any lender, particularly some of the bigger lenders, they are seeing so many applications coming through their desk and through their credit processes every single day. They're not stepping back, and it's not their role to step back and say, what is the right thing for the business? Whereas an intermediary is able to play a far more advisory type consulting role and really support the business. And with an intermediary, it's a long-term relationship with both the lender and the client to do the right thing on both sides. A lender doesn't want a client that's taking out the wrong debt product. It's not good for them, and ultimately they're going to default. And it just creates an admin burden on both sides. And equally, the business doesn't want to get the wrong debt. So if you can get that intermediary layer right, I think it goes a long way to supporting both sides of the equation.
I think as a business, it also helps to know if you're building that relationship with the intermediary. They can help guide you with, okay, today you might need to use working capital, like you said, but then the next time they need funding, perhaps it's asset financing, and maybe the same lender offers that same product, but you can get a better rate at another lender, and the intermediary can just help you connect you not just to the right funding instrument, but to the right lender in that particular situation you find yourself in.
Correct. And also remember, we're talking about small businesses. We're not talking about big corporates that can afford to hire people to do every single role. These are businesses that are taking out debt as and when they need it. They don't need someone in the business who understands every product across every bank, across every lender. So I suppose it's also bringing in an expert for a marginal cost to the lender because a marginal cost to the business because the banks and the lenders often pay referral fees, to give them like real advice to support the growth of the business at the right time. And like you say, as the business transitions through different stages, because you've built a relationship and they have supported the growth of your business, it's an easy phone call and a trusted relationship to take your business to the next level or to support in getting out of a sticky situation.
And of course, funding is very important to the small businesses. Like you said, they can't afford to hire more people, to expend capital in the way that a large corporation can. Capital, we are seeing, is really an economic enabler. When and why do you recommend should a business consider accessing funding, such as a grant, when they might not have cash flow issues right now?
So just starting at the beginning, I think everyone should be responsible for capital of their capital, regardless of size. I don't think being a big corporate with a nice big balance sheet excuses you for being lazy or for not being responsible with capital.
That's fair.
But the second piece to that is I do think that there is an anomaly with small businesses, and it is a little bit of a South African, but it's across the small business type business that I have seen, and that is, it's almost like a fear of debt. So I don't think that all small businesses truly understand what leverage is and the power of leverage. And it's for two reasons. One, I think businesses, they know they need cash and whatever, but there is either they've grown up and there's been a family business where they've seen the business has been completely drowned because of debt and being in the inability to pay back debt. And now they don't want to take out debt because they are scared of it. I think there's also a cultural thing attached to it where you've been told your whole life, don't touch debt. It's dangerous. So there's a little bit of a stigma attached to it, and a poor understanding of how powerful debt can be. And I think, and that is where, going back to the bigger corporates do understand debt. Go and look at any JSE-listed company, any big corporate that's been exceptionally successful. They all have debt on their balance sheets. And they all have debt because debt can be a massive enabler for economic growth, as you mentioned. But it's understanding how to use debt responsibly that is that. And that's the education piece that I think small businesses need. It's understanding if you can go and sell a product for 10 Rand and the debt costs you 8 Rand, you're making 2 Rand profit. The risk is that your debt costs you 11 Rand. And that's where you've got to be careful. So I think the challenge with small businesses taking out debt is they always go, can I afford the interest? I think the question's got to be tweaked slightly to say, what is the cost of capital, and what does my cost of capital generate me in revenue? And am I beating that cost of capital? Which is the key link.
So it's not about the interest rate, it's about how much money are you going to make with the funding that is given to you.
Yeah, so it's more about what can this capital generate for me, and then can the business afford it? Obviously, if you're going into negative cash flows, you're in trouble. You should never be in that position. But using someone else's capital to enable growth in your business is a massively powerful way. And that is a lot. I do see a lot of businesses that come to me and they are stuck. They've never taken out debt and they're at a certain point and they want to grow, but they don't know how. Because they haven't really thought about a growth plan. They haven't thought about, if I go and borrow 1 Rand here, how do I make that 1 Rand 2 Rand? Or how do I make that 1 Rand 50? It's, it's kind of this 1 for 1. And it's unlocking that use of funds story, which is so important for a bank.
I like that you're actually using the example of how do you turn 1 Rand into 1 Rand 50? Because I think if you're looking at the larger number of whether it's 100,000 capital that you're now unlocking through funding, how do you translate that per unit that you have to sell or per service that you have to deliver to actually get that return on investment?
Yeah, and I'll go back to the fintech lenders, that fintech lender point as well. And I really do think that they play an important part in the market, and they've created access to capital that was never there before. So it also shouldn't sound negative, but it's more about the understanding link that I don't think anyone has fully appreciated yet, and what happens next. But so I've had a client who's come to me with a project, and they've with a contract. The contract's signed, everything sounds great on paper, but they can't deliver on the contract without debt. The challenge is they've got to deliver on their contract within 3 months. So it makes sense. The contract is lucrative, and there's a nice margin in the contract. So let's just use numbers. I think it's easier to use numbers. So the contract's for R1 million. The cost of the product is R1 million. If they get the contract right, they'll get R1.4 million. So that sounds great. Now they go to a fintech lender, and to take the debt out for 2 months, it'll cost them an extra R200,000. So now all of a sudden their cost of the million is 1.2. That's fine. And if everything goes well, absolutely would 100% recommend that they go to the fintech lender, they get that contract right, they establish, and they create a track record for themselves. What happens often, and it is the understanding the risks of the business, is there's contract leakage. Now suddenly, that instead of having that debt for 3 months, they have it for 6 months or for 9 months, and that 200,000 suddenly costs 400,000. Now you've made no profit, and even worse, costs 600,000. And suddenly, it was actually might have been better for you not to take the contract at all. And I think that's the understanding piece that also needs to happen. It's capital for the right reasons, but also understanding the risk that if you take that short-term capital and that short-term debt, you stick to it and you do whatever you can. You've got to manage that loan piece the same way you're managing the contract. And both have to be settled. If there is any leakage, it risks all being for nothing.
Conversations like these are so important, and that is why the SME Funding Summit is so important. It will be happening on the 18th of June at Focus Rooms in Gauteng. Remember to grab your ticket before they are sold out. So what you're saying there, Jenna, ties to project readiness. Why does project readiness matter as much as funding?
Yeah, so for exactly that same reason, if you have, particularly for project finance, it is typically quite expensive debt. You have roll-up facilities, but you might also have penalties if you miss payments, and it becomes very expensive. The viability of the project and the profit and the margin that you make out of a project is reduced substantially if you get the debt package wrong. So it's looking at that and being able to manage those cash flows effectively.
How can you ensure that you are aware of what you're getting yourself into at the start of a project before you take on that debt and it actually costs you more?
So it's funny, and I think there's two sides to this as well. So I find in a lot of cases, businesses get very frustrated with lenders because they say they only look at historic information and they don't take into account our forward-looking. And we didn't have this project last year, so how can you be looking at last year's and trying to make a decision on the business? In the same way, in the project, if you don't forecast those cash flows as accurately as you possibly can forward and make sure that you are going to be able to make every repayment, you get into trouble. So the business has as much responsibility as the lender to look forward and make sure that if they do get it right and they get that debt, that they are able to service, repay, and they do sensitivities. I think that's what's also key. Like, what ifs happen all the time. You know, no one could have what ifed COVID, but you know what, it came. And so you don't have to go as extreme as that, but what if there's a month delay? What if there's a 2 months delay? What if our goods get stuck in China?
Or something like the floods in Cape Town.
The floods in Cape Town, and all the petrol prices go up and we can't transport. All those what ifs have to play into it, and you have to have a safety buffer. If you don't have the safety buffer, you know, you need to reconsider the you just reconsider. I mean, there are lots of things you can tweak in a project. Sometimes debt isn't the answer. And I think that's what also surprises clients when they come to me. They always expect me to be pushing them to a lender. Sometimes debt is not the answer. Sometimes the answer is to do something else, or to look at it completely differently, or to use internally generated cash flows, or to use it conservatively.
So that might mean either saying no to a project so you can build up reserves to say yes to the next project.
Correct.
Or saying, how do we adjust internally to ultimately reach whatever goal it may be?
Yeah. So, I mean, I've got a client at the moment who's rolling out a project. They are theoretically working on 10 sites a year. Now, in a perfect world, what will happen is each site, you kind of fund the first site, and as the first site finishes, they pay for that, and the next site comes online. So it's actually a very small debt number that rolls. Their risk is that suddenly 5 come live at the same time when they've already got cash out the door. So what we're facilitating there is that they actually are using their own internally generated cash as far as possible, but we have a backup undrawn facility that in the case where suddenly 5 come online and the client is pushing, you don't risk not being able to deliver, but you're only drawing on that expensive debt for a very short period of time to enable it. And their cash flow forecasts have allowed them to be able to see that they can do it and they're still not going to be loss making. So those are the kind of scenarios that I'll build with clients to say, this is the right answer. These are the options that you can look at. This is who we should talk to. And then matching them to the right funders.
That's so important. And you mentioned with forecasting accurately. So we know that funders look at how the business will grow if that funding becomes available to the SME. But we're also seeing that from the lender's perspective, the SME might not be indicating clearly enough how that funds will be used in the business to facilitate growth. What advice do you have for entrepreneurs?
So I think it's incredibly important to be honest as an entrepreneur, to be honest with yourself, first and foremost, with your business. And that means you don't gloss over risks. So you've got to be able to articulate a proper growth plan. What is a growth plan? A growth plan is not what you need the funding for. Oh no, for marketing. Marketing is not a growth strategy. Marketing is a hope strategy. And that's the reality. Like, hopefully you have a great marketing campaign and it does grow your business, but there's no guarantee in there. What is a growth strategy? A growth strategy is that right now I can only produce 10 widgets with this one machine. If I buy 2 machines, I can produce 20 widgets, which means I can double my production. That's a real strategy. And what does that do for a lender? A lender says, if I'm funding marketing, what do I get? I get nothing. So guess what? The answer is no. If I'm funding a machinery where I can see a proper growth thing where your 10 widgets now becomes 20, but actually might become 25 because you've created efficiencies across the thing, and your profit margin is better, you're able to repay the debt quickly. And guess what? If you can't, or you can't sell those widgets, I can take the machine. That's a much better story for a lender. So it's about being able to articulate how your growth strategy is going to produce revenue. You borrow money to grow revenue. So you've got to be able to link the two. And then equally, you've got to be honest about the risks. So a lender likes to know that a business knows how to manage risk. They like to know that this is scenario A, base case, the machine now produces double the amount. Upside case, the machine produces more and we're able to sell them all. Downside case, we're sitting on stock. Then what? And what's the plan B? So it's being able, having an honest conversation so that the lender knows that the entrepreneur is able to manage risk, understands risk, has a backup plan. It might also be, what happens if I have this key man walk out tomorrow? How do I manage around that? What have I done before? The other interesting thing, and I don't know if it is a question, but I'm just going to shift there. Lenders love to back a jockey. So as much as people think, I have it a lot with very early stage businesses that come and they want funding, but they don't have any history, and they don't have any sort of anything that they can show on paper, no financials. The business started, the fintech lenders will lend to businesses that are only 6 or 12 months old. So maybe they have 6 or 12 months, but they haven't really got much. But if you've got a founder that has done this before, that has sold a business that's been successful, that can demonstrate some sort of track record, most of the time you will find a lender. 99% of the time you'll find a lender that will support that business, because it is banks back people back people. That's the irony. Behind all of the lenders and behind all of the businesses are real people. So if you can put 2 people together and they can understand that this guy's done it before and he was successful in doing it, he maybe had some trouble and he was able to manage around it, and was able to then sell the business or whatever happened, but he can demonstrate some sort of track record, 99% of the time they will fund you.
That's the founder's test, right?
The founder's test. So sometimes it's, even in the growth strategy and the growth plan, coming back to what the question was, sometimes it's about the founder and how they're able to articulate not only the business, but who they are, and how they see business growth.
So I know another thing that you do help businesses with is the health check. And I believe it's the health check that really empowers the entrepreneur to understand what are these important information points that they need to articulate. Can you explain a little bit more about how a business can conduct a health check and why it's important, etc.?
Yeah, so I think I don't think businesses do this enough, and I do appreciate that, when you're running around as a business, you've got 10 million things to do, so you're not thinking about it. But the reality is, I think businesses do this too late. So a business that goes to a bank because something's happened and they're desperate for funding is in a far worse position than someone who's actually doesn't need debt today, but they're just doing a kind of health check or an overall review of their business at this point in time. I think what those health checks, and I'm not talking to mine specifically, but what a general health check will do is it identifies gaps in the business that you didn't realize were there. And gaps are not always bad. It'll be like, this facility that we have is actually quite expensive, or Flip, let us look at our working capital cycle. We didn't realize, we have to pay suppliers within 30 days, but our debtors are only paying us in 90 days. So suddenly we have the 60-day gap that we're funding with working capital all the time. The easiest thing to do is go renegotiate both sides. Pay suppliers after 60 days, get your clients to pay you after 60 days, and you've suddenly created cash flow that you didn't know was there. And now you might not even need the debt. So it's that kind of health check that just, it's a quick step back. Let us just look. Also hiring people when you don't need people because you're so busy all the time. It might just be an efficiency check that small tweaks to your business can do it. And also raising debt when you don't need it means debt, especially cheaper debt from the bigger banks, the big 4 and whatever, is cheaper, but it takes longer. The banks will tell you it takes 6 to 8 weeks. In my experience, it takes 3 to 6 months to get it right, but costs significantly less. So if you don't need debt now and you're willing to wait for the right facility, it will cost the business less. So while you moving up the growth curve and getting to the right point, if you can wait for the debt rather than going to the day before, and now all of a sudden you need it desperately, so you go to a fintech lender, get the cash for 48 hours, but are paying 2 to 3% a month for that debt, which then compounds and the whole thing spirals. So I think a health check is a very valuable piece of, and it doesn't have to be done in detail. I'm not suggesting that you bring in business specialists and anything like that. The founder can do it quite easily by themselves. I mean, with AI today, you can put some of the things you're thinking about through a Claude, and it'll give you some gaps that you've got in your business. It's not big or expensive exercises. It's actually just taking that moment to pause.
But the gaps that you either identify through a consultant on your own with some AI help, etc., it still gives you some indication of where you can also grow and scale, right?
Correct. Yeah. So I think, and that's the point. Sometimes you want to grow and scale and you assume you need debt to do that. You don't always. And if you can do it without debt, at some point when you do need debt, that debt is so much more powerful because it creates more cash flow over time.
Jenna, this is so informative, and I'm really looking forward to continuing this conversation as well as some other conversations at the Funding Summit. Thank you so much for joining us today.
Such a pleasure. It's been great to be here. Thank you very much for having me.
Awesome. If you liked this episode, please share it with other entrepreneurs that you believe might find value in it. But also remember to like, follow, and subscribe to our podcast on all of the podcast platforms where you enjoy listening to your podcast. Bye.